Why the Australian property market's finally ready to crash. Cash rate could see mortgages rise a whopping $1,250 a week. Inflation, it's crazy out there, and I'm sure you're probably wondering what this all means. All the insane headlines this week. Is the market on the precipice of crashing? We're going to cover it in this video. We're going to go through what the inflation rate means for the property market this year. We're going to talk about what's going to happen, I guess, for mortgage holders if you're looking at buying this year. Is it going to cause a massive crash? And what impact it's going to have if you currently have a mortgage, and if you should, what should you do? So let's jump right in. The big news this week was inflation figures came out. Like you can see here, the underlying inflation was the highest rate it's been in almost 15 years. It was 5.1%, the highest level since 2001. Underlying inflation, the RBA's preferred measure, spiked to 3.7%, smashing the 2.3% target. And I guess we're all feeling that. We're seeing fuel prices up, Nathan. We're seeing costs of rent, food, electricity, all the things up, and that's causing inflation to go up. So what happens is the Reserve Bank tend to then try and slow down the inflation, keep the costs down, and they do that by putting the cash rate up. And that means mortgages become more expensive, and people ultimately spend less and try and save more money. So what was some of the rhetoric on the rate rise there, Nathan, and what's that kind of looking like for people out there?
Yeah, it's really interesting to see that the bank's attitude towards the rate rises has actually changed. They're all sort of predicting that rates were going to rise after the election. And it's interesting having a look here, NAB, ANZ, they're all forecasting rates to rise at before the election in May. So they're all sort of saying May is when they're predicting the rate rise, which is actually this Tuesday. So this Tuesday is when the Reserve Bank meets up and goes through whether or not they're going to change the rates. Now, the prediction is a 0.1% increase. So maybe not the 0.25 that everyone's expecting, but there is likely to be an increase. And we've seen JP Morgan, AMP, and a number of others all join in and say that they're really thinking rates are going to rise.
And the interesting thing with this, I guess a couple of people this week asked me, what happens when the cash rate goes up? Do the banks pass it on straight away? Do they pass the full amount? The answer to that is it depends. Most banks tend to be pretty quick to pass on rate rises. With the rate decrease, sometimes it takes them 2 or 3 weeks to pass it on, but it can happen straight away. And typically, although the cash rate might go up by 0.1, the banks will tend to kind of bolt on an extra bit onto that. So they might, the cash rate might go up by 0.1. The banks might choose to do 0.2, 0.3%. And if you've got a variable rate, that's going to get passed on to you. The other thing that I guess gets forgotten in all this news too is even if you're renting, potentially your landlord's mortgage is going to go up, and then that's going to start to be felt in other sectors. So it's going to make a pretty big impact, which probably comes to this next point and how much the rate rise will cost you. So the crazy stat on this one, more than 1 million borrowers across Australia have never seen an official cash rate rise. So I kind of like this article because it's got some of the difference it's going to make. So a 0.15% increase in interest rates on a $600,000 home loan is going to increase your monthly mortgage repayments by about $47. A 1% cash rate increase, which they're expecting by December, will increase the monthly repayments by $284. And the 3.4% cash rise increase, which they're saying it could happen then, but I guess as with all these things, the economists haven't really got it right much lately, have they, Nathan? Because I think a year ago we were talking about, the RBA had said cash rate was going to be on hold for 4 years. Now they're saying cash rate's going to go up. So I guess trying to predict out to 2023 is going to be a bit hard to do. But if it does happen, like you can see here, a 3% increase would increase your repayments by $1,000. So I think the thing that a lot of people are getting caught up with on this stuff is they kind of freak out and it sounds like huge numbers. It's going to go up 1%. I'm not going to be able to afford it. I think it's at times like this, you need to kind of take a breath and even run the repayments, check out a payment calculator, because in your case, a 0.15% increase is $47. It's not nothing, but it's still hopefully not going to cause any big stress. A 1% increase is $284. It's still something, but it could be Netflix and cutting things back, and I guess that's the intended impact of the rate rise.
Well, yeah, even looking at an example here, let's say you have a $500,000 mortgage. There are talks, NAB's predicted in their forecast that they're thinking rates are likely to go up from the official cash rate they were sort of predicting the cash rate at June would be 0.1%. They've actually said that they think it's going to be higher. So they're predicting a 0.15% increase. So that this forecast that they've done previously, they've even reviewed this. But they're sort of predicting by the end of June 2023, we might see as high as a 1% increase on the rate. So, I mean, for mortgage holders out there who are a little bit worried and not sure what that actually it means to the bottom line, if we look at a 500,000 mortgage, rates at the moment anywhere in the 2% mark, let's say they go up by 1%, that's going to make a difference on your mortgage per week of about $50. So $486 is what it goes up to from $426, so about $60.
And probably a question I've been asked a lot this week is, should I look at fixed rates? Do fixed rates still make sense? Now, it's all going to come down to your situation. It's obviously general advice, but you can see from this chart on my screen here that the proportion of fixed versus variable rates has basically dropped off. And most people are probably opting more towards variable at the moment, because what we've found, I guess to Nathan's point, like I said, the variable rates might be sort of in the twos still at the moment. If you're looking at fixing, the banks have already costed in the next 2 years worth of rate rises. So the 2-year fixed rate, for example, at the moment across a lot of the banks is pretty much at 4% or even in some cases above. So in a lot of cases, you have to sit down with your mortgage broker and see what's going to work for your situation. The costs have kind of been factored in there, and fixed is probably making less sense than it was a couple of months ago.
Yeah, particularly with fixed rates at the moment, we've seen the rates move a huge amount. So previously, about 4 months ago, we're getting fixed rates in and around that 1.89%, fixed in for about 2 years. The banks nowadays, they've actually increased that fixed rate. You're looking in the mid to high threes. So that increase in fixed rate for 2 years is actually becoming harder and harder for people to justify in terms of their costs and whether it makes sense or if it's worthwhile to do. So one thing that we have seen is a lot of people rethinking whether they want to fix or not. I think fixed makes a lot of sense if you do have a very tight budget, and any increases in the future is going to make a substantial difference to your day-to-day, week-to-weeks.
Yeah, or looking at a shorter fixed rate term. Lately, I've had a couple of clients that are looking at potentially 1 year fixed rate. So at least you know for the first year, as you're getting settled into the home, you've got some stability. You know what your repayment's going to be for the next 12 months, every week. And then after that, you can kind of review, maybe getting a pay rise, things like that are going to happen. But I guess the question that we're getting asked a lot is, will this affect property prices? What's going to happen? With property interest rates, it's obviously fairly interconnected. Repayments go up and things like that. The Reserve Bank, well, a couple of the banks have come out and said that they're expecting potentially prices to soften in Sydney and Melbourne, as we've seen. And I guess that's off the back of some insane growth last year. Nathan, what's your sort of view on this, and what's going to happen sort of next with the markets?
I think, as we've talked about in the past, look, we've had a lot of growth. I think in the last 18 months, there's been 30% growth in some areas, which is absolutely insane. Look, any cooling off of the market, I mean, we've seen such terrific growth. We looked at it previously where Sydney had a $1,000 a week increase in values of their properties. And then I think earlier in the year, there was a 1,000 reduction in value just for the month alone. So we've sort of got to put it all in perspective. Yes, the change in interest rates is going to make it a little bit more challenging. It might slow down the growth, but I think all in all, there's still plenty of demand out there. Yes, interest rates are going to go up, but we're seeing things like wage growth continue. We're still seeing a lot of demand for housing, and that affordability piece, if it does cool off, will mean that it makes it a little bit easier for first homeowners out there to get in the market.
Yeah, interestingly, looking at history, I've got an article here from Propertyology, who's a buyer's agent research house here in Brisbane. Previously, when interest rates went up between 2002 to 2008, interest rates increased from 6.3 to 9.5%. And during the 6-year period, the median house price more than doubled in 6 of the 8 capital cities. So if you look at some of the figures historically, like interest rates have obviously helped with the property market increase over the last few years. The banks have factored into their servicing ratios. So even today, when you're applying for a mortgage, you're getting your income and the loan repayments factored in at like a 6.5%. So that's, already been factored in. The banks have kind of stress tested people at that point. It's not like in America where they're doing it sort of based on interest only repayments. But one thing that definitely is going to impact first home buyers as the rates go up is the servicing ratio. So you just want to touch on that, Nathan, and how even say a 0.25% cash rate might reduce your borrowing capacity, or say 0.5% as we saw late last year.
Yeah, so as we start to see interest rates rise, we are going to see that the borrowing capacity is going to go down. So the banks do use a benchmark effectively when they do an assessment. They look at the rate you're actually getting, and then they usually add a 2.5% buffer or 3% buffer in some cases when they do that assessment. So whilst variable rates go up, so will that buffer of 2.5%, 3%, which actually then reduces your ability to borrow by about anywhere from that 5 to 10% mark, depending on how much the interest rate rises. So something to keep in mind because it is going to affect your ability to borrow. And once again, in turn, as we've seen in the past, with increased borrowing power, so we see prices rise. With reduced property borrowing power, we might also see that cooling off of the increase in value of properties. Once again, I don't think it's a bad thing. We've seen a crazy rise in an upward trajectory with property prices, increasing by 30% in the last sort of 12 to 18 months. So all that we feel is going to do is going to slow down that craziness and hopefully slow down that growth.
Yeah, definitely. I think property's not about timing, it's time in the market. I guess the advantage of owning your own home as opposed to renting is actually going to pay it off over 30 years or the next couple of years. And probably the other shift I think we're going to start to see is people might start to be, where possible, looking at maybe say like a 2-bedroom apartment instead of a house. They might still start going back to, subletting rooms to friends and mates to help cover some of those expenses, which we haven't really had to do over the last little while. But overall, the market's, the prospects looking pretty good for property. If you're looking at buying and you need help with finance, here at Galloway, we're mortgage brokers. We help home buyers across Australia. So we'd love to help. Like even if you're wondering what your borrowing capacity is, what some of these rate rises might mean for you and your individual circumstances, you should definitely hit us up. We'd love to help. Nathan and I here, can help out. So check us out at huntergalloway.com.au. And even if you sort of jump on the website there, we've got a couple of webinars coming up as well that you can register for. So thanks so much for watching. What do you guys think? Are you worried about rate rise? Are you worried about things in the world? Do you think it's going to affect market? Do you think it's going to be all good? Let us know. Hit us in the comments below. And if you've got any questions, we'd love to hear. Till next time.